All right. Sorry, let me just go back. Yeah. All right. So, ladies and gentlemen, for as long as you are going to engage and start looking for money externally, these are some of the documents that you need to pay attention to. Okay? If you have, first of all, if you have not registered, at least register, formalize. You can register as a business or as a company. So please, and for those ones who registered and they don't know where their documents are, start organizing. Have your documents available. Authenticity. Have these documents available, filed. Okay? Have these documents available. Okay? These are the common documents you'll come across. 2, business license or trading license. That is important, but it's not mandatory. And usually you can get it as and when, for those of you who find it not essential, because some of you are strategically located where you have to have a license, while some of you it may not be relevant. But when you start engaging investors, you may find it's one of the compliance requirements. So just be in a position where you can get one. I'm not saying you get one now, but be in a position where you can easily get one as and when the opportunity is there. Have a copy of your memorandum and articles of association. If you have registered as a company, have your memorandum. What are the terms you've agreed as a company? Usually when you register a company, you have a memorandum and articles. Okay? If you've registered a business, obviously you have what you call, I don't know, there's like a document. Yeah, have that document. You know, there are people behind a company. So have your national ID or passport. If you are the director or business owner, they will not know you by Roy. I know Roy. Hey, he know. We need evidence, and the evidence is national ID or passport. Have that available. Okay, don't wait until it happens. The other thing usually that is checked is you have a TIN. In some countries, it's called PIN. It's one and the same TIN number, PIN number of directors or owners. Now, for some of you who are still starting, this is not the first thing you do, but it's something that you can get in a day. As long as you go to the URA website and you are ready to get a TIN, that is something you can easily get. Usually for the owners, they give you very fast because you are saying you want to be a taxpayer. Okay? Annual returns or filing receipts. Usually when you register your business, a company, every year you have to communicate to URSB that you still exist. So you usually pay a certain fee. It's just 25,000, if I'm not wrong, the last time I checked. So usually it's a document that shows that the company is still in existence. So, but still, when you start interactions with investors, that is something you can get. That can take time. Tax compliance certificate, still. When you engage, an investor is bringing money into a company. So the government is very keen to ensure that this money is coming in the legal, to do a legal activity. So they need to ensure that they're giving somebody who is also following the compliance of the government. So you will need a tax compliance certificate. But as I say, these are things that if you're not registered, you can get. But if you are registered, then you need to be compliant. If you are not registered, that is something you can get. Okay, you don't need to say, now I need to get it now. When you get an interest, and those are things you can easily get in less than a month. So no worries about that. But if you've registered and you're not compliant, then try and start being compliant, because you never know. You don't want to find yourself with a good opportunity, and now because you have not been compliant, things are not in your favor. Audited financial statements. Okay. Now, for starters, it's I will not say all of you have audited, and usually it takes a bit of time to have audited because you spend money to get auditors do that. But at least start with having what we call management accounts. Management accounts are income statement, balance sheet, and cash flow statement. Every year, end of year, at least have an accountant come in, give him your records, let them develop for you the income statement, the balance sheet, and the cash flow. For starters, have that. Okay, then once you have the resources, you can have audited financial books. At least have management accounts that you are keeping your records, and somebody can easily follow how your business has been running. If you don't do that, you deny. And these are the best. In fact, most financials, one of the places they are very worried is record keeping. Can you imagine most of, I don't know how many percentage of business do not just even keep their own records. Yeah, their own records, basic records. Just recording and say, okay, I took 50,000. I gave Roy 100,000. I gave Grace 150,000. Just capturing that. When you capture that, even if you've taken 5 years without giving a financial, you can get an accountant and he will compile for you management accounts. Now, these management accounts can now be audited. So the most important thing, basic, just start recording. Get an accountant book. Record, just record, just develop that discipline. It will even show you, maybe you are killing the business by taking a lot of money, or the business is okay based on the money it's generating. So it's just good to record. That is one of the key things I would really emphasize. Keep your records, because that is the biggest concern that most financials have interfaced. Hard transparency, these people don't keep, they don't register. If you have a if you have a bank account, where necessary, ensure that money goes through the account so that the bank has some transactions. And that's why my next point is certified bank statements. Usually, they ask you for your bank statement to be sure that you are actually transacting with the bank. So some of you who are doing cash, at least try and be depositing. By the way, you can take, I can take 1 million to the bank and withdraw 2 million at the same time. If I need the money, you can deposit and withdraw. By the way, I've done that quite a number of times. I go deposit money and I pick because I need it, but I need the bank to, I need it to be reflected on my account. Said, I don't know when I'll be engaging investors again. Okay, so the bank statement is important. That the money is yours, or for the business, but just ensure that at least the bank shows there's some transaction, because at some point you may need money. It could be from the bank or other options. Since you have that transaction, they can appreciate what you're doing. Okay, the other thing I would recommend, depending on what you do as a business, have supply orders. Those people who order for you, from you in bulk, I know I've had this interaction with Edwin, have supply orders. Now, they may not write down that, Edwin, I want, they will call you, Edwin Jagara, 400 whatever, pieces, or 600 in 2 days. You can develop a template and say, Nini, order is from Nani, confirm 700 templates. You just send him to sign. Or you can send on computer and say, just confirm on email. That is evidence. That is an asset. It's like collateral. We can use it to get you money. Okay, when you develop that practice of capturing those orders, I have 50 orders I have not fulfilled. I have 40 orders. I met Mr. John Nwagaba. Nwagaba told me he has 40 orders. He has not fulfilled. Now I said, okay, do you have evidence of those orders? I have, but I have the orders. Now that is difficult. How does somebody start helping on that one? Okay, but if you have this capture, or you say, okay, by the way, can you just sign this? Because some of our customers do not have these things. Or say, okay, you just sign, or yeah, so that, because sometimes you don't have money to supply the orders and you need to get money. So why shouldn't you just have evidence of the order so that you can easily fulfill and also attract resources? And then financial projections. I think we did financial model and I showed you how to do projections. We shall still do that next week on Thursday. For those who will be stuck with financials, we shall do hands-on. We shall walk you through just to ensure that everything is in order. So these are common documents that you will come across. Okay, and based on the documents, you'll find that they attract different opportunities. Okay, so the most important thing, at least have authenticity, just be aware that these documents are as long as you're going to be engaging financials, these are documents you'll find yourself in need of if you've not yet organized them. Just have a file and put your things, have a counter book, always record, have that tendency. Whether you are the one or somebody else, have that tendency. Okay? Feel free to ask me any question on this. How does an investment process look like? Okay, you as a startup, you come. Okay, some of you say, I've got an investor and the money just comes immediately. Boss, it is a process. Okay, you as a startup, when you attract the interest of the investor, what they do is they can initiate connection and they will do initial screening. They'll ask you probably to send some of this document I've informed you about. They will check these documents, Okay, they are in our website. They will just do their background check, initial screening. Then they will come maybe to the site and visit and check. Okay, then after doing the assessment, what you have, what you own, how the business is running, where the market, how much are we making, etc., 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 they will evaluate. They will assess the value of the business. Okay, after assessing the value of the business, then you will develop a structure. Okay, they will say, okay, we are going to invest, but now this is how the deal is going to be structured, or these are the terms. So you agree, that is the structuring. This is how we are going to invest. Maybe we shall give you this amount, we shall give you this other money, we are not going to give you. We feel this is a risky, that activity is risky. We shall give you money for A, B, C, so they can structure how they're going to give you. Then after they invest, usually they will do monitoring and value adding. They'll be monitoring, checking on you, maybe recommending investor experts like us to come and check on you. Oh, I've checked, I think Mr. Edwin is doing well. They can connect to some sales experts to support you so that you increase or whatever. Yeah, they'll keep on supporting because they want to ensure that they get return. And this process usually happens most especially for equity, because here you are getting into a relationship. So they have to also see that they are contributing towards your development. While if it was a loan, obviously you go, they assess and evaluate, they assess you, they get collateral and give you money. But for equity, that is usually the process that goes through. Okay. All right. So now some of you, this is interesting. Many of you, many people always say, now when I get an investor, are they going to be there? By the way, for your information, and I just want you to know that investors come to your business, or those ones who invest equity, they come in with what we call an exit strategy. They know that they are going to come in, they are going to invest, but they have to look at how they are going to come out. Are they going to come out by you buying back from them? So sometimes they evaluate, okay, if the company grows, maybe we shall give, usually it's the first option. They ask the entrepreneur, can you buy back the shares that you gave us? Now, if it is valuable, obviously you'll pay much more. Maybe they gave you 100K, but you'll pay them $500,000. It's a win-win situation if you don't want other investors to come in. In some cases, you can say, me, I'm tired of this business. Let me sell you more shares. Okay, so there you may find investors buying you out, so they can say, Gracella, you've taken this company, you've now we've reached at a point, but we want to buy you off. Based on the value, currently the company is worth $1 million. We have 30% of the business, that is worth 300,000. So I want to give you 700,000. To Chigale, you continue wherever you can be an investor, go and rest with the family. We want to continue. Deal or no deal. So there, Grace will say, now you see, you can decide, it's okay, that's a good deal. Maybe she has now another idea of establishing maybe a textile factory. She has already experienced this. That can happen. You can be bought off. Okay, you can be bought in or can be bought off. Okay. A good example of buy-in is like, I don't know if you saw Facebook. Facebook bought WhatsApp. Facebook bought Instagram. They were trying to buy the technical team. You know, sometimes you cannot hire the best out of, but you may find they have developed a nice product and it is doing well and it can compete with you. Some organizations, what they do is they just come and buy the whole company so that they work together. And you see, that's a win-win scenario. This management buy in, they buy you in. You are part of the bigger picture, but you are still running. It's like it's your business, but you are reporting to them, but you are making more money, probably with less tech. Sometimes that happens. Some investors go and trade, like they have 30% and say, now on our exit, we are going to sell to other funds. You see, when you start as a business, initially you may start, you need 10,000. Then as the company grows, you need $50,000 or 200 million. And then as the company goes, now you need maybe, how much? Maybe you need 500. So as the company grows, you know, investors are always in different tickets or different categories. Some play a role between 10 and 30,000. Once you outgrow the appetite of what they offer, for them, they will sell their stake to this one who will give more. And as they sell the stake, obviously, they are making their money. Okay? So it usually goes like that. It's like a cycle. As your appetite of money grows, the investors you are dealing with will be different. And that is really usually how it is. Okay? In some cases, your share can be sold to other industrial partners. Okay? All right. So that is why you normally hear sometimes we have what we call Series A, Series B. Oh, this company has raised 50 million on Series B. It's because they raised on Series A. They now need to expand maybe or do more. They go Series B, okay? Now, once you finish those series, you are still raising a lot of money. You can go to the public. I think you saw Jumia went to the public. They raised over, I don't know if they raised over 700 million or 500 million. But at that point, it was valued at 1 billion. Over 1 billion US dollars. Okay, the more you raise, you're also raising the value because people now are interested. But remember, you're also serving more, so the value of the company increases. Okay. All right. Okay. Anybody who has a question on this, feel free, or you can ask as we proceed. So the one thing I just want to emphasize is investors have an exit. They come in with an exit plan. They always come with an exit plan. Okay. Okay. Just for the interest of us, sometimes you always want to know, how does an investor evaluate? I think I'll explain this in a later slide. It is simpler. This one is a bit technical. I'm going to explain that in a later slide. But what do investors look for when they're looking out for where to put in money? What do they look for? What do they look at? Investors look at the management of the business. That is the people. Who is that behind? What is their attitude? What is their? Are they looking at conquering? Are they looking at expanding? Have they overcome various challenges? Or they complain about everything, they have excuses. Okay, so investors will look at the management, they will look at the market. How big is the market? Or what is the potential of us expanding this market? Okay, market is a very big influencer. Okay, the money, and this money is seen in your documents, financial documents. They look at how the money has been, how it has been handled, and the momentum. What is the potential of this business to grow? So just to explain a bit about management, they look at the characteristics. Can we trust these people? Do they have the experience? Do they have the knowledge? Can we engage with them? Are they open to working together, or they are too emotional, whatever? So and that is why I wanted to emphasize this. Investors invest 70% in people and 30% in the product. That's why sometimes you find there's a company which may not be innovative, but just the people, because of the people behind that company they invested in. Okay, that's one of the interesting things you just may need to know. Okay, so just the same way you hear people buy people. I don't buy the product, I bought the person who sold, because sometimes the person who sells the product makes you believe and appreciate the value of that product. Okay, and that's where management comes in. Market. Okay, market. What are the products? What is that target market is targeting? What is the price? How is he promoting? What is that? You remember in the business plan, we put most of these things. So that helps us, helps them evaluate. Okay, it looks like it's a business one handling. Okay, many. Did you have your income statements? They look at the details of your income statement, your revenues, your margins, depreciation, profits, cash balances, dividends, and this helps them make that decision on the money side. Okay, on the momentum, what is the growth potential of the business? The business model, does it make sense? Are they penetrating in the market fast to create what we call barriers to entry? I think I mentioned this. What assumptions are they making? You remember in the business model, we had assumptions, okay, how you are growing, or the assumptions that you put on the projections. So they will look at those assumptions. Are they logical? Do they make sense based on how it has been performing? Then the business continuity. The market you are targeting, is it a growing market or a dying market? So for example, if I'm targeting schools and maybe COVID happens, obviously the demand goes down. Is it that I have alternative markets that I can engage, or because schools have closed? And so they look at such business continuity, because some things are changing because of the existing circumstances. The supply, we need to be sure that we shall have enough supply of the raw materials if we're expanding. Then maybe they have a unique product. Is the innovation sustainable? Is it a unique product? Then risk. Is it something easy that somebody can come in, or it's something that when we are there, we are there? Okay, I think I shared with you my story. The product was not as innovative, so it was easy for somebody to try it out. The best way of standing out is creating a brand and scaling far and wide, so that even if somebody starts doing what you do, you can easily outcompete him. You get, sometimes some of those things we need to pay attention to. All right. And yeah, if you have all those things, trust me, you'll be jumping and smiling, because you'll be closing money that people will consider rare, but because of your hard work and innovation and ambition, you'll certainly attract what you deserve. Okay, tomorrow we shall cover the pitch deck, but I just wanted to highlight now primary evaluation. I think I mentioned I'll talk about this. On evaluation, just like I mentioned yesterday, we look at market approach. You don't need to know but market approach, cost approach, and income approach. And on income approach, I showed you saw on the example, on the pyramid that I showed you about statements. Income approach was what we called DCF. Income approach is same as DCF, or some people call it discount cash flows. Okay. Cost approach is what you normally see the banks do sometimes. They just come and say, okay, Ainetaka, he has a house, he has stock. They just look at that. They don't look at other things. That is the equivalent to cost approach. We don't normally use cost approach. It's not considered fair, especially unless you are in things like real estate, mining. We can use cost approach. But if you are doing things like software, e-commerce, usually it's software which you cannot touch or see, but the impact is there. For example, Zoom. Can you see Zoom? But do you know that Zoom is more valuable than an airline? How do they calculate that? They use either discount the DCF income approach, they look at how much is it making and how much is the future based on how the market is consuming. Then they use that to calculate the value. Okay. Market approach, I'm going to explain it a bit in simple terms, but many times we look at what we call your EBITDA. You remember your financial models, we had EBITDA. That EBITDA is very important. It's actually used to value. So under normal circumstances, we normally say your EBITDA times 5 is very close to the value of the company. Just for your information, your EBITDA times 5, an average unit of 5, is very close to the value, unless you are doing software and other things. So many times, if you don't know about valuation, when you calculate your income statement and you have your EBITDA, you can easily look at your EBITDA and multiply it by 5. The assumption here is you are making profit. If you are not making profit, it may not be the suitable methodology to use. It's only applicable when you're making profit. The other thing, since we did yesterday the financial modeling, you'll notice that it helps you make the decision. Should you do some things yourself in the company, or can you outsource some things? Okay, some of you always want to do everything. Like, I'm making stoves, so I do the cover, the liner, the what from. Is it better to do it in-house, or you can outsource? I'm not saying either is okay. It just depends on how your business is working. You may find it's more efficient for you to outsource because you can have more and then focus on something, so that, okay, like you'll realize some of the Chinese products, like these computers, when you go to China, you'll find Toshiba has outsourced literally all. There's another company bringing the screen, another company is bringing keyboard, another company, okay? So that allows them to have all the equipment, quality, on time, and very fast, so they can assemble machines very fast, okay? Same to vehicle, that's how they do it, okay? So it's more of evaluating in line with your business, insourcing or outsourcing. Should I buy a transport vehicle or should I lease? Okay, should I buy land or should I lease? You know, these are decisions. They look obvious, but sometimes you may find if you are buying, it is 100 million. If you lease, it is 20 million. Now you ask, okay, if I'm leasing for 10 years and it is 30 million, maybe I can lease, then eventually maybe make a decision to buy, okay? So that it allows you to still have money within you, because you may buy and actually eat out the resources of your business, okay? So investments, maybe you can find, I want to go to the Western market, Western region. Edwin may say, I want to go to Western region. Should I invest in a company that is doing, should I buy land and start doing, or I can go and discuss with Magezi, who is in Ruampara, and we partner, or I get some stake in Magezi's company and we expand in the entire nation. Okay, so these are decisions companies make to evaluate, should I invest, should I acquire, should I start on my own, or I can buy a business that is already doing it? Should I start a salon, or I can buy an existing salon? Many times we think, based on our culture, how we have what we call an ownership syndrome. So we always want to do things. Let me start, let me do this, let me farm myself. Do you have to farm, or can you buy from farmers? Okay, these are decisions that when you use the financial model, you'll find some of these things, it helps you answer most of these things. And that's why I just wanted us to go through the financial models, because you can always experiment. You can change the numbers. Okay, if I insourced, I'm spending 70,000. If I outsourced, I'll spend 50,000. Okay, how does it impact my? So the reason why I really wanted us to do the financial model yesterday is for you now to be able to, you can put different numbers and it gives you different results. Then that helps you understand various financial decisions. Okay. All right. I have explained this. I just want. Okay. So this is what I was saying. EBITDA, common price to EBITDA ratio is 5. So if you have your EBITDA, earnings before interest, taxes, depreciation, amortization, if you pick that figure, multiply by 5, is usually very close to the value of your company. For as long as you are doing these things like manufacturing, agro-processing, stuff like that. But if you're on software, Boss, we may even multiply it by 30. Interesting, eh? Okay. Now, let me give you an example of Facebook acquired WhatsApp in 2014. Okay. I want you to see how they valued WhatsApp. By the time Facebook acquired WhatsApp, just for your information, any Facebook user, Facebook values you at $150. Each person that is on Facebook, Facebook equates you to $150, and that was in 2014. Now probably your value is even higher. Okay, so in 2014, Facebook's users were valued at $150. Now here was WhatsApp. WhatsApp had over WhatsApp had how many users? It had made sales of only 10 million. You can imagine. It had made sales of only 10 million. It had made a loss of over 138 million. Okay, so by the way, I really wanted to share this so that you can understand. Sometimes it's not really about how much profit, because depending on what you do, if it is valuable and it attracts people, some companies may be willing to buy you just because of that. Okay, so it had a loss according to the book. Even if you went to the balance sheet, it will show you that it was negative 430 million. But WhatsApp, the users, as I said, I started with Facebook. Facebook's users are valued at 150. So when it checked, WhatsApp had 400 million users. 400. Can you imagine a startup? It's making loss, but it has 400 million users. Do you know that is market? When I see this business has 400 million users, I think this is money. You know, some businesses, by virtue of just seeing the people, the customers, they equate that to money because they can look at other products. Okay, so Facebook, despite WhatsApp making losses, they looked at the users and said, let's pay you 22 billion US dollars, my dear friends. So assuming WhatsApp decided to struggle on its own, by entrepreneur, you struggle on your own, you have 100% of the business, occur losses, and here somebody wants to give 22 billion, which can solve all your problems plus your generation's problems ahead, grandchildren and great-grandchildren. Okay, so Facebook bought WhatsApp at 22 billion US dollars, and it valued the users. Now, to Facebook, it was a big bargain. For you guys, you're saying this is a lot of money, but to Facebook, it was a big bargain because the Facebook users were what? 150. So here it was buying each user at $55, which was like a big bargain to Facebook. Are you together? So, ladies and gentlemen, I hope you can see that sometimes you may be suffering when somebody is looking to actually put money in you. Okay. All right. This is the story of Microsoft. Bill Gates in 1986. Bill Gates was taking home around $300,000. $300,000 only. And then investment bankers told him, my friend, why don't you put this company in the public, sell some stake in the public, put some stake in the public. So eventually he agreed, and they calculated the number of shares Microsoft had, and they put some of those shares to be available for public. Some of you know stock exchange. So they made an initial public offering. So they put the shares in public. And according to the calculations, I don't want to go so deep, but the price per user, the value of each share was 16,050. But when it goes to the market, you see, when your shares go to the market, the value goes a bit high because of speculation. We call it speculation. So the value went high. And they advise, instead of selling at $16.50, let's sell it at $21. Now, the moment they went to the market, the first day, just the first day, the value from $16.50, The first day this was in the public, each share went for $27.75. So in other words, he almost doubled the value of the company by putting it out. Now, for those ones who, from the principles of sharing equity, I hope you understand what this means. Your value can go high because of just speculation. Okay. If you finish on the business plan, once you finish the funding request, ideally you can be able to answer the executive summary, which is basically the summary of the entire business plan. And since you all have the structure, my assumption is you should be able to do this so that when we meet next week on Tuesday, you'll be able to, we shall be able to look through this and refine. Okay. All right. Now I want to take some questions. Let me just a second. Yeah, I want to take some questions as we look forward to our guests. Any questions? I know I've tried to be a bit fast, but this is the time you can ask as much as you would wish to ask. Please ask.